All right, welcome everybody. Today we are recording our FHA Zoom for Home Sweet Loan, Navigating Mortgages with Ease. My name is Annalisa Larson. I am a RE/MAX realtor here in Western Washington. I've been in real estate since May of 2021. And today I am joined by Julie Herman, who will be leading this down the road of FHA.
Hey there. So I'm Julie. Thanks for having me. Appreciate the opportunity just to kind of help break some of the myths and confusion behind loan products because there's so many options out there that I think it's really powerful for clients to understand what all these different products are and maybe why their loan officer might be suggesting one over another. So I'm Julie Herman. I am a mortgage broker with Edge Home Finance. So as a mortgage broker, the difference between me and maybe other mortgage companies is with mortgage companies, they're selling the products that their company has. So it's just like going to a car dealership, you can buy the cars that they have. When you work with mortgage brokers, we have many car lots. So we can shop around, find the right car lot, or maybe even the right type of vehicle for you, and be able to put you into that car in a sense. So it's just really cool working with brokers over retails. That's the real big differences between the two. Discuss working on this home suite loan navigation. And what we want to really focus on today is FHA mortgages. And we want to make it so that you're not bored to death. So make sure you ask questions. These are some of the main players that we're going to be talking about over the weeks. And government-backed loans is really what we're talking about today. So some of the jargon that you might hear when it comes to FHA is DTIs. These are called debt to income ratios. What this means is basically when a loan officer is looking at your credit report's going to list out how much you owe on a debt and what your minimum monthly payment is. They're going to add those up. They're going to add in your new mortgage payment, divide that by your income before taxes, and that's how they come to a percentage, what's known as debt to income ratio. Government-backed loans are actually all owned by Ginnie Mae. So not to get too deep into this part, but when you get a conventional loan, there's actually two types of conventional owners. There's Freddie Mac and Fannie Mae. Or you can get a government-backed loan, which is FHA, VA, and USDA. And we're going to dive into each one of those as the weeks go. And those are actually all owned by Ginnie Mae. So the way I like to think about FHA loans is they're kind of like the superhero sidekick. So they're not as cool as Batman, but they're basically the Robins of the mortgage world, right? They're here to kind of help figure out when a conventional loan doesn't work. Maybe they're here for when you have a credit stumble or you don't have a lot of cash laying around, or maybe you can have credit score issues. That's where an FHA loan can really come in and save the day. So basics of FHA is really it opens the door to home ownership. Even if your savings and your credit score are more like cozy apartment than a sprawling mansion, the FHA loan product is insured by the Federal Housing Administration. So it makes it easier to qualify for than a conventional loan. The reason why it's easier to qualify is because on an FHA loan product, if you struggle, you're in a mortgage, you're struggling, you end up having to go through a foreclosure process. In a normal mortgage world, the company that collects your monthly mortgage payment, they still have to pay your principal payment to either Fannie Mae, Freddie Mac, or Ginnie Mae. Well, with FHA, they have this pot of gold that your monthly mortgage insurance goes into and some other costs go into. So FHA will actually take it out of that pot of gold. So the lender's not stuck making those payments while you're going through the foreclosure process. And because of that, that's truly why FHA is so much easier to qualify for than a conventional loan. So FHA, most people think it's first-time home buyers, and it's actually not. It is popular with first-time home buyers, but it can also be for repeat buyers. It could be through people that have lower credit scores, even down to 500. Could be people that have just sold a home and now they want to buy one, but they don't want to use a lot of down payments. FHA can come into all those different pieces. It can also be used as a really cool product to help your parents get a home and help qualify for that or help your kid. So we'll dive into all those different things, but just know that it's not just first time home buyers. There is no first time home buyer requirements to use FHA financing. And to actually dispel one of those big myths, a first time home buyer technically is someone who has never or has not owned a home or had their name on a lien or property for the last 3 years. So let's say that you owned a home 4 years ago. You're actually a first time home buyer again today. Loan limits change. So there's a national loan limit for single family homes, which is 498,000. But depending on the county that you're looking at, there's actually different loan limit amounts. And there's even different loan limit amounts between buying a single family house, a duplex, a triplex, or a 4 unit property. And loan limit, that means that that's the purchase price minus the down payment. So if you're buying a house for 600,000 and you're only putting down 3.5% and you're buying in Tri-Cities, you could not do FHA financing because the amount that you need to borrow, that leftover amount after your down payment, that's higher than the loan limit. So if you were buying in Seattle, they have a much higher loan limit. So you could do the $600,000 purchase with only 3.5%. So you always just want to find out what county that you plan to buy in. Your loan officer should put together a chart for you that says, if you're buying in these counties, here's what your loan limit looks like. And then they can earn 3.5% to that. I'm just going to move these questions over to the side. Annalise, you asked a question. You said, how does getting DPA affect that? Is it the loan limit that you're talking about?
Yeah. Since the loan limit is minus the down payment, if you're getting a loan for your DPA, is that affected? How is it affected if it is?
It's not. So on the back end of FHAs, you have two different ratio percentages. So the front number that they look at, that loan to house value has to be 96.5% or less. If you look on any advertisement on the very, very, very tiny bottom section when they're giving you amazing rate quotes online, it'll say things like 35% LTV. That means loan to value. So that means that somebody had a house purchase and they put down 65% to be able to get the LTV down that far. So on FHAs, the front end needs to be 3.5%, but they allow you to add down payment assistance on top of that. So they allow you to finance up to 105% of the value. So if you have a loan limit and you're meeting that, you're buying in Spokane, your loan before the down payment assistance is 498,257. Your first property, the purchase of that property, that lien is good. And then the down payment that you borrowed, the 3.5%, that's counted as a second lien. So it doesn't actually go on top of this loan limit on the first. So hope that made sense. Let me know if it doesn't. We're going to dive more into down payment assistance, but that was a really great question. Credit score is a big positive when it comes to FHA. So when we get into the conventional module and we talk about how credit scores work on interest rates when it comes to loans, FHA loans, you don't get that same what we call level price adjustments on the interest rates. So our credit itself, the higher your credit score is, the higher debt to income the loan program will allow you to borrow, and it'll put you in a different bucket where they feel that you're less likely to default on the mortgage. When your credit scores are low, you're going to be in a bucket of higher default chance. And so that's where maybe the lenders are a little bit tighter or more scrutinizing of your loan application. So let's say somebody has a 700 credit score and somebody has a 590 credit score. They're both putting down the same down payment, but this person with the 700 credit score is going to be, in the eyes of the lender, less likely to default. So this person might be able to go up to 57% of their income to buy a house, versus this person, they might want to see their percentage of their income used at 43%. And then their interest rates are going to be different too because of this different factors. So, interestingly enough, FHA can actually go down to 500 as a credit score. A lot of times you're going to see advertising from mortgage lenders that say that as low as 580 as a credit score. That's because that lender has what we call overlays. So different mortgage companies out there, let's say that again, you're just selling just their product that they have. They're going to look at risk and say, we don't want to take on the risk of really low credit score. So we are going to say our limit is this number, even though FHA allows us to go further. So they can set those rates. They can also say you can't go as higher in the debt to income ratio, or they can even say you can't have, a non-occupying person helping you get that mortgage. They can set all of those extra rules, which are called overlays. As a mortgage broker, I get to go through all these different companies that I'm aligned with and go, okay, I know these companies don't allow a 500 credit score, so we'll move them out of the bucket, but these ones do. Now, the difference is with FHA, if you have a 579 credit score to a 500 credit score, your down payment needs to be 10%. They're not going to let you purchase with only 3.5%. Because again, chances of default are high because your credit score resembles your payment history. So if you have a 580 credit score and you qualify with all these other items, FHA will allow you to purchase with only 3.5% down. So that's pretty cool because you can't get a 500 credit score loan going conventional. Down payment, we talked about this, just an example. So let's say you're buying a house for 450,000 and your credit score is over 580. 3.5% is super easy to calculate on a calculator. You just take 450,000 times 3.5 and then hit the percentage button, and it'll spit out your minimum down payment. So this is your down payment that you'd be responsible for. Now, down payments with FHA, they can be gifts from your family members. They could be gifts from your uncle. They could be a gift even from your local church. We're going to have to look at the paperwork and make sure that we can track how you get it. You can't just get a bundle of cash that magically appears, but you can get gift funds. So that's a really cool thing that FHA allows. Debt to income, again, this is one of those things that are going to go lender by lender. FHA says you can borrow up to 57% of your income. So remember, again, we're going to look at your credit report. We're going to take all the minimum payments that you have for student loans, for credit cards, for a car payment, those up. We're going to add in whatever your new mortgage payment with your property taxes and your home insurance is going to look like. And we're going to take that number, divide it by your income before taxes. So FHA says you can borrow 57% of your income to cover all of those debts. Different lenders are going to have different overlays again. Most retail lenders, which are places like Caliber Home Loans, Fairway, different companies like that, and banks, they're probably going to limit you about 50%. They don't want to go on that high end. A lot of other lenders that we have out there, they'll allow it to go up to 57%. Typically, when you're about 55% of your income, what they want to see is a couple of positive attributes to go along with good credit. They're going to want to see that you've been renting for the last 12 months and that you've been paying your rent on time. And they'll do what's called a verification of rent. So they'll contact the landlord and just make sure, hey, has Johnny been making all of his rent payments on time for the past 12 months? And they go, yep. They're going to look at your employment history. So if you job jump a lot, they might not be comfortable with you going that high of a percentage of your income used. But if you've been pretty stable at the same company for 1, 2, or 3 years, again, that's another positive attribute that they're going to look at. The biggest attribute that they look at, which is the hardest, is they want to see 1 or 2 months worth of your future mortgage in your savings as a reserve. Now, we can use your retirement accounts, your TSP accounts. We can use money market accounts that you have where you're not having to cash that out and put it into a savings, but you have the ability to be able to liquefy those accounts if you ever got into financial struggles. So again, if you're going up to about 55% of your income, you're probably not going to be asked for additional positive attributes to your file. But if we're pushing to 57%, we're going to be looking at some extra things. Terms, most people think of mortgage interest rates as two different terms. Terms is how long you're going to finance your loan. So most people think there's a 15-year financing or a 30-year financing. And in fact, again, that's just an overlay. When you work with mortgage brokers, we can look at all the different lenders and they might offer a 30-year financing, 29, 28, 27, all the way down. You can even look at a 22-year finance term. And that might push your debt to income higher. But if again, you got attributes like you're coming in with a good down payment, got a little bit of savings, you have good employment history, and you're doing 25-year mortgage, this might not even be an issue going up to 57%. So they look at your whole file. These are some of the other things that they look at. So a big myth is employment. People think you need to be at the same company for 2 years. And that is absolutely wrong. Uh, what they want to see on your loan application is what have you been doing for the last 2 years? Were you in school? Let's say you were in high school finishing 12th grade, and 7 months ago you got out of high school and you immediately started working full time. We can actually use your high school unofficial transcripts to show what you've been doing for the last 2 years. Let's say you were a stay at home mom for the last 6 years and you just went back to full time work for the last 3 weeks. That might be one of those situations where they say, hey, we need you to have a little bit more time in this before we're comfortable using your income because you haven't been working although you've been working, you've been paid, unpaid working for the last chunk of years. So every loan application, we're really going to look through it and see if there's reasons. Sometimes we've had situations where clients needed to step back from working to take care of somebody that was sick, like a parent. And so they took 7 or 8 months off of work, but they had a full-time position prior to that. And they're back to full-time work for several months. We just need to explain it with a letter of explanation because the underwriters, which are like your file gods, they look at all of those different things and they'll look at that explanation and say, hey, I understand why this person wasn't able to work a full-time job for the last 2 years. So that is okay. We're going to make an exception, move forward with the rest of their file. So there's exceptions, but that big myth is you don't have to be at the same company for 2 years. When it comes to income, one of the things that we do have to watch for is how you're paid. So let's say, for example, you're a car salesperson and most of your income is commission. And let's say last year you worked at Nissan, this year you're working at Kia. Even though you've changed companies, what we'll actually do is we'll look at your 2-year history of your commissions made. And as long as the current year is the same or higher than last year, we'll average your 2 years worth of commission because you're in the exact same industry. We know you're just moving to a different company. If, let's say, you were working full-time W-2 jobs, you're getting paid every hour, 40 hours a week last year. And then this year, you're now working at a new company and you're getting 40 hours a week and overtime. We won't be able to use your overtime income because in the last 2 years, you didn't work overtime. So when it comes to income, you'll see a lot of times loan officers will ask for your last pay stub for the last 30 days and the last 2 years of W-2s, if you're a W-2 employee or you get bonuses or commissions, because we have to figure out what has your history looked like on income. If you're a business owner, we'll absolutely be able to do FHA financing. They'll want to see that you've owned your business for 2 years and they're going to look at your tax returns. Last year, was your tax returns the same as the current year? Is your current year profit and loss statement showing that you're kind of within that same income? Or do you have a significant loss this year? Maybe you did a ton of write-offs this year and you didn't do those write-offs the prior year. Then we'd actually have to use the lowest income. When we look at self-employed, we're going to look at your income minus all your deductions, whatever you state afterwards is your real take-home income. That's the income that FHA is going to look at. So just know that there's there's adjustments that are available when it comes to employment and credit. There's exceptions that are completely doable. And there's situations where maybe you need to have a full 2 years in that company. Mortgage insurance gets a little confusing when it comes to FHA financing. So let's just first talk about those buyers that have a credit score over 580. So you have a credit score over 580, you've only put down 3.5%. Every year, your mortgage insurance is going to stay on your loan. It never goes away. The insurance is that gold bucket that we talked about at the beginning, where if somebody that has an FHA or has a government backed loan defaults on their mortgage, this bucket of money is where the servicers take out that money to help them. And so when it comes to mortgage insurance, that goes into that bucket. So that never goes away if you're only putting down 3.5%. It reduces annually. And right now, they look at changing it every couple of years. But as of 2024, mortgage insurance cost is about 0.55% of the loan. So it's easy to actually calculate it. What you do is you take your loan amount, you times that by 0.55%, divide by 12. So that tells you each month what you're looking at payment. So if you had about a $400,000 FHA loan, you're looking at around 192 a month in mortgage insurance. And as your loan balance decreases every year, your mortgage insurance that you pay also decreases every year. Now, if you purchase the house and at the very beginning, the day you purchase the house, you put down 10% or more, on year 11, that mortgage insurance evaporates and goes away. In FHA mortgages, to keep that monthly cost that low, regardless of a credit score of 580 or a credit score of 800, everybody pays exact same mortgage insurance cost. And in order to keep it low, what they actually do is charge a chunk of it up front and they finance it into your loan. So again, let's pretend that you purchased a home at $400,000. So the upfront fee that FHA charges you is 1.75. So if you bought a home at 400,000, you put down 3.5%, you are financing $386,000. FHA is going to charge you a fee of $6,755. That is what they call the upfront mortgage insurance premium. That $6,700 they finance on top of your 386, and it's not included in your loan limit for the county. So if you had a loan of 386, now your monthly mortgage payment is going to be based off of a mortgage of 392,755. So again, if you times that by that 55%, that comes out to be 180 a month in mortgage insurance. And then that 6,700 was on top of your mortgage. So you're splitting it to help monthly wise keep your monthly payment down, but they still charge that upfront to you. That's really important to know because if you're going to purchase a home today and your game plan is, let's say in 7 months, you plan to sell that house, you're only going to live in it for less than 1 year, or in 7 months, you plan to refinance out of FHA because you're getting a huge lump sum of money and you're going to convert it to a conventional loan. You don't want to do an FHA upfront because you're basically costing yourself $6,700. Regardless of when you refinance, that $6,700 fee, it's gone. You never, ever can get that back. So it's important to talk to your loan officer really early about how you plan to do this purchase and what your future, both short and long term, is looking like so that we can help you pivot the right way. FHA loans are super cool to actually use you to help become a landlord. So technically, you can purchase a single family home, a duplex, a triplex, or a 4-unit property and use FHA as long as you plan to live within the house in one of those units, and then you're going to rent out the other ones. Now, FHA is the best route to go when you're buying a duplex. So on a duplex property, you're living in one unit, and then the second one you plan to rent. It doesn't even have to be rented yet. the sellers might have actually already have it vacant so that they don't have to deal with giving notice to tenants when they go to sell. But the appraiser that comes out to make sure that the home's worth what you're going to pay for, they're going to look at the market and tell you how much that rent on that single unit's going to be. And as a lender, we can use 75% of that projected rent to help you actually qualify as if it's going to be future income that you're going to have. And you still can purchase it at 3.5% down. So that's a really cool way to maneuver into buying a property to live in and getting a renter in there to help you offset your own mortgage payment. The reason I say it's best for duplexes is because FHA has this really tough program that when you buy a triplex or a fourplex, you have to pass a self-sufficiency test. What that means is they look at your entire complex, all 4 units. They put you living in one. So now you have 3 out of 4 units. They take the rent out of those 3 at that 75% marker. And that leftover amount that you're going to collect for rent, that has to be larger than your mortgage. A lot of times it doesn't work out to be that way because we're taking away 75 or 25% from every single unit. So in that case, if you're looking at buying a fourplex, most likely you want to look at a conventional product because under conventional, you can buy that property, live in one of those units, and not have to do that self-sufficiency test. And you only have to put down 5%. So Annalie, great question. You said, do you have to live in one of the units for the entirety of the loan? No, you don't. So when you purchase an FHA, we're asking that you're making a minimum expectation that you're going to live there for about 2 years. It's not set in stone. You're not going to go to jail if for some reason you decided to move out earlier, unless you moved out or never moved in or moved out within 10 days. That's going to be suspicious. It'll look a lot like mortgage fraud. But let's say you move into the property and it's been 12 months or 13 months and you got good renters in 3 units and you're ready to look at buying another property and maybe using conventional financing this time, and you want to keep this one. You don't have to change this mortgage at all. You can move out of your unit, rent it. And when you're buying your next property on your tax returns, you can show the lender that you're already getting rent for these units over here. And we can actually use that to offset that mortgage. So let's say your mortgage is $3,000 a month and your rent is with property taxes and home insurance. Let's say on your tax returns, you're reporting $4,000 a month. On the next property that you're buying, we can give you a $700 income to use on the next property. So again, we're going to depreciate a little bit just in case you have a vacancy factor. We're going to use the majority of that to cover this mortgage. So now your debt to income doesn't have to include house number 1 at all, and a little bit of income to cover number 2. And if, again, you're buying another fourplex using conventional financing with 5% down again, we can use those future incomes to help you buy that property. So it's kind of cool how it works, but you don't have to live in there for the entirety of the time. And when you move out of any property, whether it's a house, whether it's a duplex or fourplex, you do not have to change your financing that's already happened on the property. You can just move out if there's been enough time and move into something else. FHA, also FHA, VA, and USDA, they all use the exact same appraisal form when the appraiser is going out to the property. Now, when you're comparing conventional loans to FHA, FHA is a lot more pickier on structural integrity and standards when the appraiser is looking at the property. So they are not going to be doing what we call home inspection. Home inspector goes out to the property and he's looking over everything. He's checking how the dishwasher works. How good is the washing machine? When he turns on all the water in the house, is there any leaks? The home inspector is really important to look at those things. The appraiser, he is going to do things that he can see at normal height. So he's going to step onto the sidewalk, look up at the roof. And if the roof has blue tarps all over it, or it's obviously not going to last 3 years, he's going to call that out in the appraisal to get a roofing company to come out and to look over the property. They're going to be concerned about that because our roof replacement is very expensive. So they're going to call that out on their appraisal. If they walk into a room and the dogs chewed a hole in the carpet and it's not a big deal, it's probably not even going to be called out. Now, if let's say he's walking up to the house and you've got 5 stairs walking up to the house and there's no railings at all on either side of those stairs, that could be a safety issue. They're going to call out needing a rail. So those are a few of the things that they're going to look at, and typically conventional doesn't. Now, blue tarp on the roof, a conventional appraiser is going to call out and say, hey, what's up with this roof? Because that's an issue if the lender ever needs to take possession of this home, or that's going to be an issue for insurance. But typically, the conventional appraisers are going to call out that railing that's missing on a couple stairs. Um, you could have no carpet in a room. It could be just bare subflooring, and conventional is probably not going to call it out versus FHA will. The other big one that FHA looks at that we see a ton is wood rot and peeling paint. So wood rot is outside any of the wood structures. Let's say that you have a wood garage, and at the bottom of the wood, it's not on a concrete pad, it's just straight on dirt. They're going to look to see if the bottom of that wood is starting to rot, because that's going to be a structural issue, and you want them to see that. If the garage is on pavement and the wood's just starting to look like it's fading, they're probably not going to have an issue. If the house itself has a ton of peeling paint all over the house on the outside, the appraiser is going to be concerned about that, because again, that's going to be structural that you need to consider repairing, and they're going to call that out to get repaired. So there are some things that an FHA appraiser is going to look at more stricter than you would with some of the other loan products. But just remember, if you're getting an FHA loan, a USDA, or a VA loan, that appraisal form is the exact same for all of those homes. FHA has so many different types of loans. They don't just have your standard purchase loan. They also have renovation loans. They have construction loans. They have reverse mortgages, energy efficiency loans, and even graduated mortgage payments. So we won't get into all of those, but I think the 3 important ones to know about are the renovation loans. So one of the cool renovation loans that FHA has is what's called a 203K streamline. Let's say you walk into a house and it has the worst paint color ever. Every single room has a different color, and the carpets are horrendous. They're nasty, they're dirty, they stink, they gotta go. Maybe appliances too, maybe they don't work or they're not working great and you want to get the appliances covered. What you can actually do is roll in those renovation costs. So in your offer, the seller, we need to know that you're planning to do a renovation loan, just a streamlined one. We need to get some quotes for the carpet. We need to get some quotes for the paint. We need to get some quotes for the appliances and for delivery and all that kind of stuff. And then in the renovation, the appraiser, when he goes out to the property, he's going to look at the renovations that you plan to do. He's going to look at those quotes, and he's going to make sure that once you do these couple of things, that the value of the house will increase enough to cover those minus your down payment. So what we can actually do is lend you all of those costs in the mortgage, and then we'll pay the contractors after closing to get those things installed and done. So that's a really cool product. They have another one, a renovation loan. This one's more so, let's say you need to gut the kitchen and do flooring, countertops, cupboards, appliances, the whole thing, and it's going to be a $45,000, $60,000 renovation. That's, again, something you can finance within your loan with FHA. We're going to look at, again, what all those contractor quotes look like. It's going to be a little bit more intensive on that one because you're doing big renovations. We need to get all those renovations done immediately after you get possession in the house. The big thing that I see people do is they think that in this renovation loans that they can do the work themselves. And unless they're a licensed contractor specific in those items, and unless they can prove to the loan company that there's not going to be an issue with them completing all that work and getting all those materials, a lot of times homeowners cannot do those renovations. It's got to be set up through contractors that we can go and talk to about why they're not getting the work done. Energy efficiency is another big one. So if you're buying a house, we see this a ton in Spokane County where you've got um, older furnaces or hot water tanks, or maybe even just really old windows and they're not energy efficient. Again, we can talk about the grades that you want to do on those, what that aftermarket value would look like, and fit that into the mortgage. Any questions from you guys at all? So we'll move on to refinancing. There's a couple different ways that FHA works when it comes to refinancing. So, what refinancing means is when you've purchased your home and you've been in there for a while, the markets always change with interest rates. If we look at the last 64 years in interest rates, they've done this over time. So, at some point, it might make sense to reduce your interest rate and get what we call a rate and term refinance, where you're just changing the terms of your loan by reducing your interest rate. It might make sense that you want to take some cash out of your house and maybe pay off some debts, pay for Johnny's college funds, or on a vacation. Or sometimes people take cash out of their current house as a down payment for their next house. So then we could do what's called a cash out refinance. A really cool thing that FHA offers that conventional does not is what's called a streamline refinance. So again, this streamline program only works where you're looking at reducing just the interest rate. So let's say you're in an interest rate of 7% today, and in 13 months from now, interest rates are, let's say, 4.25. It's a no brainer that you want to refinance from this rate way down here. Sometimes when it comes to refinancing, clients don't qualify because maybe their debts have changed or their income has come down a little bit. They haven't missed any mortgage payments at all. They've been able to pay their numbers, but maybe one of you had to step back and stay at home. So now your income's less than when you first bought the house. And so we have a streamlined program. What that does is we look at your credit. You need to have at least a 620 credit score or higher. You need to have not missed any mortgage payments. And inside that one, we're not going to do an appraisal. As long as the rate you're going from to the new interest rate, that savings that you're going to have every month, the cost to refinance needs to be made up within the first 3 years of those monthly savings. And if those savings are there, it's just a really easy process where we just do a rate and term refi without the income verification, without looking through all the bank statements, without making sure really you can qualify. Because we already see you've made these payments way up here and never had an issue, and your credit's still in a good spot. We know that giving you a lower interest rates, it's going to make your monthly payment a lot better. So then we can streamline that. And we don't have that in conventional. In a conventional loan, when you refinance, you have to 100% qualify it all over again to be able to reduce your own interest rate. Sometimes when I have certain clients that I feel like maybe it's going to be a struggle for them in the future to refinance, this is one of those things we talk about, is why maybe that person, I might suggest, let's talk about an FHA loan instead. So we set you up for success. Because even though you're going to have a monthly savings in the future, if you're maybe somebody that struggles with employment, or you're going to struggle with income in the future, big things are coming up, or you're just worried about really being able to qualify later, this might be the better route for you to go. This program does not work if you have down payment assistance. So we'll dive into why, but you can only do a streamline when you put down the 3.5% purchase price. Down payment assistance. This one is a huge chapter, and I will try to keep it as bite-sized as possible. So here's a couple of things that people don't know about down payment assistance. So down payment assistance means you're going to buy a house, you don't have quite enough to pay for the down payment, or maybe you don't have enough for down payment and closing costs, or you just don't want to spend it out of your cash source. You could actually look into down payment assistance. You are borrowing the money you need for the down payment on the house and possibly for some of the closing costs. Anytime you borrow, you know that there's a devil's advocate, right? So when you borrow to come into the purchase, your interest rate on both the amount that you've borrowed and the interest on your main house are going to be higher than normal. So let's just throw out random numbers, but let's just pretend today's normal FHA interest rate was about 6%. Down payment assistance loan, you're probably going to be somewhere around 6.5% for the interest rate. Because where the money comes from to lend it to you is from the cost of the interest. So the lenders get to keep that interest every month, and that helps them help funnel more payment assistance down the line. When you go to sell or refinance, you got to pay off that down payment that you've borrowed. And that's in the form of a second lien. So when you have a house, you're going to have lien number one against it. That's your main mortgage. So if you turned around and sold it tomorrow, you couldn't just have all the cash from the house. The escrow company is going to look at what you owe your mortgage company minus your sales price, minus all your costs for closing. And they are going to take the difference and first pay your mortgage and then give you the difference. If you have a second lien because you had down payment assistance, they're also going to take from your savings or from your sales. They're going to pay off that second lien because those are both registered with the courts to show that there's a lien. It's just like a vehicle, right? When you when you buy a vehicle, if you're paying cash, you get the title for the vehicle right away. You can turn around and sell that vehicle if you wanted to. You could get a lien against the vehicle and get cash if you needed to, but you own that car. You don't owe anybody anything. But when you have the car, you can't just turn around and sell somebody the car and not pay the lender that you borrowed money from. And that sits as a lien with the DMVs. Same with houses. We'll talk about a separate application process for DPA. We're going to talk about that in number 2. But so when it comes to down payment assistance, there's lots of programs. Most people think of the Washington State Housing Program. I have multiple other lenders that actually have down payment assistance in Washington. I have a lot more lenders that can do down payment assistance in California, Arizona, and Idaho. And the reason why is the Washington State Financing Commission, they have a really tight hold on the market for down payment assistance. So they make it really difficult for other companies to come in to be able to do down payment. Now, let's talk about Washington State financing first, because a lot of people think that that's the first time home buyers program or the bond program, and they have a couple pros and cons. So the big pro that they have is that they put that second lien against the house, and then that second lien, you don't have payments for the first little bit until you refinance that loan and you get rid of that second lien by paying it back. Or when you hit your 30, then you start making payments on that amount that you borrowed. Because they don't have payments, their interest rates are much higher than any of the other programs, and they charge a lot more in closing cost. They also have it so your lender does your mortgage, and then towards the very end, before your final setup is done to sign all your final paperwork and get the keys for your house, they then have to send the file to Washington State Housing for a couple of days, and they recheck to make sure that there's no things that you've missed. They will not let you borrow if you have too much of a savings. So if you have a lot of savings, you can't get a down payment through them. And they also have income limitations. They're very strict on debt to income as well. You can't go over 50% debt to income ratio. You have to have a 620 or higher credit score. And again, you also have to do a home inspection. It's a requirement. You also have to do their home education. If you do it online, they charge $50 a person to complete, or you can spend 8 hours in person going to a free class, but it's a requirement. The other lenders that I have, they underwrite themselves. So that means that they don't have to send it to another company. They hold the loan. So they do a one-time underwriting. If they say you get down payment assistance, you get down payment assistance. They also do not require a home inspection. I highly suggest a home inspection, but sometimes it's the way that you have to do it to win that offer, or maybe the seller's already done one, but they did one 6 months ago. So you don't have to do a down payment. You don't have to do a home inspection with their program. You do have to do home buyer's education, but they allow you to use Freddie Mac's education online. It's super easy. It's about 40 minutes, maybe total, and it's free because they know that it's a struggle to come up with the money right now. Otherwise, why would you do down payment assistance? So I like their program better. They have two options. They have an option where it's 100% forgivable and an option where you make payments. The forgivable program is really good for people that have a lower credit score. So if you're 620 to a 680 credit score, you're probably going to do the forgivable one. That means that as long as you don't refinance, you don't sell the property, you don't do anything to have paid off that first loan, 5 years later, they'll forgive that down payment and never charge you for it. In the one that's not forgivable, their interest rate is a lot cheaper. So remember how we were talking about 6% as a magic made up interest rate today for FHA standard? If you were getting the monthly repayable down payment assistance program, maybe you'd be at like a 6.25%. So they don't charge a ton in interest rate because you're paying off your second loan every single month in a monthly payment. So it puts you at a better spot to eventually just be able to refinance your house and use some of your house's value to pay off that second loan. They also allow for duplex. So there's no income limitations at all. You can make $500,000 a year and do the down payment assistance program versus Washington State Housing. You could not. You could have 10 months worth of savings in your savings account and do down payment assistance. Washington State Housing, you cannot do that. You can buy a duplex with this program. Washington State Housing, you cannot. You have to buy a single family house, or you can buy a manufactured home where you own the land with a 680 or higher credit score. In this option, you could buy a duplex. So remember earlier we talked about living in one unit and renting out the other one. You can do that with this down payment. We can use it as future income, help you to qualify and get you into a property where you're immediately starting to make some revenue for yourself. Refinancing, I talked about, but it is really important to know that when you go into down payment assistance programs, let's say you've borrowed $17,000. It's going to take a little bit of time for your home to have that value or for you to have those cash monies available to pay off that $17,000 that you've borrowed. So quite typically, when we see somebody get down payment assistance, they're not looking to refinance for several years. And the question was, is there a separate application process for down payment assistance? And it's not. So when you apply with the mortgage lender, they use that loan application for both liens. Lien number one, which is the main mortgage, lien number two, which is the down payment assistance lien. So they use the same paperwork. We talked about qualifying credit is important to know on that duplex. You need to have a 700 or up credit score. You need to have a 660 or higher credit score for the repayable. And I apologize, I think I said on the other slide 680, but it's 660 or higher to repay the monthly payment. Minimum 620 credit score for the forgivable loan. And if you're buying a manufactured home, it needs to be 680 or higher. I like this option too. So when you get a down payment assistance loan, let's say there's two of you applying, boyfriend and girlfriend, husband and wife. Okay. And let's say one of you, your credit scores are 750. One of you, your credit scores are 580. They will actually take your two credit scores and blend them together to give you a better credit score. So it's going to lower, of course, the guy at 750. But in a mortgage, when you have two credit scores, whoever credit score is the lowest is the entire file's credit score. So in the down payment system, in that program, they'll take both your credit scores, blend them together to come up with that average score. So now maybe you qualify for that duplex because they blended it together. So I love that. I think that's really cool. You can't have prior property foreclosures. That's pretty common sense right there. But if you had a foreclosure 4 years ago, 7 years ago, you're not going to qualify for down payment assistance. They do care about NSFs, and that's for every single loan program, period. They all care about NSFs. That's why one of the things that they look for on your bank statements, do you have an NSF history? If you have a history where every other month you have an NSF for your bank, it doesn't put you in a great light to qualify for a mortgage, because that means that every month you're running negative and you're writing checks that you can't really cash. So they will care about that. And especially with down payment assistance, you have any kind of NSF, it's not going to qualify. You can use this program for USDA for your closing costs. So in a USDA loan, which we'll get into more in our other modules, it's a real 0% down payment assistance, but you have closing costs when you purchase a house, which is usually 2 to 3% of the house price. So under this down payment assistance, you can use this to get your closing costs covered. You can borrow up to 6% of your loan amount to cover both the closing costs and down payment. And then we talked about, of course, the type of home that you're buying. You can't use this. You can't use FHA for investment properties to purchase. And you cannot use this product for second homes. So you have to plan to live in that home within 60 days. Something that's very different in FHA than conventional is what's called assumable loans. A whole section we'll talk about. But assumable loans means that you, as the home owner, you're selling your house at a lower interest rate than the market, and you're letting someone else assume that balance. You cannot do that with down payment assistance because you have that second lien that would change when the loan got assumed. So you can't do it with assumables. Again, you don't have to be a first-time home buyer, no income limits. We need to include your spouse's debt as an obligation. So if for some reason your spouse is not coming on your mortgage, but you're legally married, we need to include their debt in your income ratios or any FHA loan. This was the spot about Washington State housing, just the differences between the down payment assistance programs. So that's just on there too. Let's talk about assumable loans, because that's actually a really cool product that a lot of people don't know exists. So an assumable loan means that somebody is selling a house with a current FHA mortgage, not having a second lien on there. So they have a current FHA mortgage and they want to sell the house. So one of the things that they might market is, you can buy my house and take over my current mortgage at this low of an interest rate, but just pay me the difference. So how that could work is, let's say that the seller is selling a house for $500,000. That's how much they want to make off of the sale of their house. But they have a loan balance of $315,000, 2.99% interest rate. Now you don't have cash to cover $185,000. That's the difference between $500,000 and $315,000. And you don't have that cash. That's a lot more than 3.5%. You can actually get a second loan on the property as a 30-year fixed mortgage for that second chunk that you need. So now you could take loan number one at the lower interest rate if you qualified, and then you could take out a second loan. Now, you have to be careful how you work on this. So on an assumable loan, the current seller can't be behind in their mortgage payments, and they can't be in what's called a loan modification. So during COVID, some people just had to go into a loan modification because they couldn't make their mortgage payments. And if that's the case with the current seller, they can't sell their current mortgage as assumable because they owe the banks more than really the balance. So if it's just somebody straight has a 315 and they have a 2.99% interest rate, they just want to sell their house. So this is how that payment would look. So first, let's just start with option number 3. Let's say you want to get a new loan, $500,000 purchase price, 30-year loan. You put down 3.5% down, which was $17,500. And then you went FHA financing, because I just want to compare apples to apples so that you can see. I just put in a random interest rate based on what MBS Live says today the average FHA interest rate is. You can see that there's no APR listed because I don't have closing costs in here. I don't have that breakdown because our MBS Live, they don't show what that breakdown is for this interest rate. But this is just to show you the difference between monthly payments. So if you're looking at a 6.55% interest rate, that monthly payment is going to be about $36.74 a month. Now, the current seller, right, he has a $315,000 balance. at 2.99, his mortgage is 1802 a month. That's really attractive, that difference. But again, you don't have 185,000. So this is what that 185 would look like. So on your loan of 185, you put down 5%, so only 9250 instead of 17.5. I just put a random higher interest rate because these are second mortgages. They always have higher rates. That payment's only 1288. When you combine loan number one and the second loan, combined, that monthly payment is 3,092. That saves you 584 a month. Not only that, you saved on your down payment. If you're purchasing that house at 500,000, you were looking at 17.5 down or 9250 down because you borrowed 185. So assumable mortgages are actually a really cool product. I like them for FHA because when the seller is done and their current mortgage company approved you to take over the loan and they're done with the deal, nothing is hanging over their head. They get to walk away. On a VA loan, assumables work kind of the same, but if the seller is a veteran, obviously is a veteran, is qualified for a VA loan, but the new buyer coming in is not a veteran or does not qualify for um, uh, their own VA benefits, the seller loses their benefits in the house. So we'll dive a lot deeper into that one when we come to the VA spectrum, but the same concept would exist. On that VA loan, you could do the assumption on their first mortgage, get a second loan for the balance, and then have a monthly payment that's really low. So really cool product, right? When you qualify for an assumable loan, it's a little bit trickier. The current owner, again, can't be behind on their mortgage at all. And you have to apply for the assumption through the current owner, through their current mortgage company that collects their monthly payments. It usually takes about 45 to 60 days. And the current company that is servicing the loan, they're going to have much higher overlays than normal. So they're probably going to want to see a debt to income ratio of around 43% with your first and second mortgage combined. They're also going to want to see you have a higher credit score, and they're going to want to see that you have a more consistent income. So they're going to be stricter to look at and qualify because you're taking over a loan from somebody else. So they would just prefer that it's a much cleaner deal for them, less of a chance of default. Manufactured homes are a totally different beast on their own, but they are really great for FHA loans. So on a manufactured home, whether you are a first-time home buyer or not, if you're buying that home with a conventional loan, you have to put down 5% minimum. On FHA, again, you don't have to be a first-time home buyer. You can purchase a manufactured home in a park or where you own the land with only 3.5% down. Now, there are some differences that you need to know. So let's first deal with in the park. Because a lot of people think manufactured homes in a park, it means that you're renting the spot that your manufactured home is sitting on every month. I don't even do those kind of loans because they have a very, very small amount of lenders who will finance those. The problem is that the current landowners, they can change the rules. They can increase your monthly rent. So your lot rent, maybe when you moved in was 500 and 3 years later, maybe it's 1,500. They can sell the land and give you a small notice. And now all of a sudden you have nowhere to put your manufactured home. So there are a lot of reasons why lenders don't like to lend inside a park. So aside from being in a park, let's now talk about where you own land. So on a manufactured home that already exists on the land, that home needs to be newer than June 15th, 1976. And that's for double wides and triple wides. On single wides, the home needs to be newer than 1992 on a single wide. So on a double wide and triple wide, they need to be newer than 1976. And the reason why is the production of manufactured homes went through a lot of safety changes in 76, making manufactured homes much safer to live in versus 1960. Even if we look at manufactured homes over the decades, If you look at a home built in 1998 versus 1976, the manufactured structure is much better. USDA loans won't even let you purchase a manufactured home if it's older than 2008, because again, it's just the way that the manufacturing has improved over time. Loan limits are the exact same as that casualty. So we just have to look at where you're wanting to buy and we can tell you what that limit's going to look like. You need to have at least a 620 if you're coming in with your own down payment as a credit score minimum. You can't buy a manufactured home with a 500 credit score, even if you're putting down 70%, they won't qualify you. And that's because manufactured homes, they're a lot more difficult for lenders to sell if you foreclose on them. We talked about the down payments, again, 3.5%, but there is another maximum on the debt to income ratio on manufactured homes than there is on a single family built house. When you're buying a manufactured home, there's one more additional inspection you have to pay for, or the seller has to pay for. It's called an engineering certificate. So you would hire an engineer to come out, and what they do is they look underneath the home. So they're making sure, first of all, that the home is properly cemented down. So whether it's on blocks, it's on a pad, it's on even a basement that was created, it's properly secured to that property. They're looking to make sure that the skirting around the manufactured home is in good shape and connected. But one of the big things that they're looking at is to make sure that it's not twisting. So a manufactured home cannot have been moved from one property to another. It has to come from the plant it was built at straight to the property and not ever moved. They are going to make sure that underneath it hasn't twisted over time, that it's not breaking down or anything that's going to make it a huge safety issue. Because again, if that happened, you wouldn't have a home to live in. So that's a good inspection, but it's a required inspection. And it's going to be generally between $400 to $800 to have that done. So this is just a program comparison because there is a lot to take over about FHA. So let's first talk about conventionals. So they are less picky on the appraisal process. They require 5% down on a manufactured home, but your mortgage insurance eventually goes away. On a VA loan, veteran loans do not have a debt to income limit. So if you're a veteran, make sure that you come to our VA module because there's a lot to learn. They allow for lower credit scores. They have no down payment requirements, streamlined program for refinancing, and overall, they're a really great way for qualifying military members to use. And then USDA loans, again, they have zero down payment program, but you're going to learn in our modules, they have a lot of limitations on credit score, income, location, type of properties. And a huge one is what's called household income. So that one's going to be a big one I would talk about. Our FHA, most down payment programs are FHA backed. Manufactured homes only have 3.5% down payment. Mortgage insurance is for life unless you put down 10% at the time that you purchase and then it goes away. Has that awesome streamlined program for easy refinancing. Is assumable, allows down to 500 credit score. Down payment program allows us to blend two people's credit scores together to give you a higher overall credit score. And appraisers will definitely look at roof life and peeling paint. So that's kind of it for what I have about just the overview of FHA financing. So what kind of questions do you guys have?
I'm not seeing anything popping up in the